Hello, my name is Angellin. I'm from class 24A2. So today I will explain what that I got from chapter 6 until chapter 13, the chapter 6 intermediate accounting IFRS edition. Okay. Accounting is often described as the language of business. However, what I come to understand through studying chapter 6 to 13 of the intermediate accounting edition is that accounting is more than just a language. It's a system of reasoning, a structured way of thinking, and a tool reflect real economic event through reliable numbers. This chapter has expanded my technical knowledge while also shaping the way I perceive financial information. Each chapter builds on the previous, creating a clear and structured path that guides us from fundamental concepts such as time value of the money to complex issues like estimating liabilities and valuing intangible assets. Below is a detailed reflection of what I have learned, how it has impacted my understanding, and how I plan to apply this insight in my future academic and professional career. Okay, for the chapter 6 is accounting and the time value of money. The concept of time value of money is one that appears simple on the surface yet has deep implication in both finance and accounting. I learned that money today is worth more than the same amount in the future because it can be invested and earn interest. This is crucial when measuring long-term obligation and making fair value assessment. True formula is like FV equals to PV and PV equals to FV strip buka kurung 1 plus I pangkat N. I developed the ability to solve real-life problems such as what is the present value of loan to be repaid in 5 years? How much must be invested today to accumulate a future sum? These competition are these competition are used not just by accountants but also by financial analysts, auditors, actuaries, and investors. I also learned the difference between simple interest, which is rarely used in professional setting, and compound interest, which compound interest is the foundation of many areas in accounting, bond, leases, pension, and not receivable and rely on this concept. Beyond the numbers, this chapter helped me realize the importance of comparing values over time fairly and using consistent discount rate to present future transaction in today's terms. Alright, this one is for chapter 7, cash and receivable. Cash is often seen as the simple asset, but this chapter reveals how complex cash management and receivable reporting actually are. I learned how to classify cash, including restricted cash, which must be disclosed separately when set aside for specific purpose like debt repayment or capital projects. I also study receivable and the various types. Uh, First type is trade receivable arise from customer credit sales. The second one is non-trade receivable include advance tax refunds and claims. The third one is the non-receivable are formal interest being arrangement. One of the most impactful insights was understanding how sales revenue must be reduced for expected return and bad debts using the allowance method. Estimating uncollectible account ensures that receivables are staked at net realizable value, providing a more accurate picture of expected inflows. I also explore how companies manage liquidity through factoring receivables and the accounting treatment under with recourse or without recourse condition. This sector bridges the gap between accounting and real-world cash flow management. Okay, for chapter 8 is a foundation of inventories, a cost basics approach. This chapter marked a turning point in my understanding of how cost measurement plays a critical role in both of the balance sheets and income statement. Before this chapter, I view inventory as simply goods to be sold, but after studying this section, I realized inventory valuation is complex, judgment based and inflation on reported profitability and asset valuation. First, I learned the difference between inventory system. The perpetual system maintains real-time tracking of inventory balance and cost of goods sold. It's more accurate and preferred by large retailers. The periodic system updates its inventory only at the end of the period, relying on physical counts. This led me to understand how errors in physical counts or system entries and directly affect net income because of COGS equals beginning inventory plus purchase time minus ending inventory and overseas ending inventory will understate COGS, thus overstate profit. The next important concept was cost flow assumption. Under IFRS. Companies can use FIFO. FIFO is first in, first out. Assume the oldest inventory is sold first. In times of rising prices, this result is lower COGS and higher profit. A varying cost method spread costs evenly and reduce price volatility in financial research. And LIFO. What is LIFO? LIFO is last in, first out. It's not permitted under IFRS, which I found interesting because it highlights how different accounting standards can change the financial picture of the same company. Moreover, I learned how to distinguish product cost and period cost. Another valuable section discussed in inventory errors. This mistake didn't just impact the current period, they can forward. For example, if 2024 ending inventory is overset, it will cost 2025 beginning inventory to be overstated as well, affecting COGS and income for two consecutive periods. This concept show me that inventory management is more than operational, it's a strategic and financial. This chapter reminds me the inventory valuation is not neutral. It involves assumptions, estimates, and choices that managers make, all of which affect how the company is perceived by stakeholders. Okay, for chapter 10 is acquisition and disposition of property, plant, and equipment. In chapter 10, I transited from learning observed current asset to long-term asset, specifically property, plant, and equipment. This chapter was not only about recording assets but understanding how companies invest in their future operation. I learned that PPE includes assets like land, buildings, equipment, furniture, and fixtures. The central idea is that PPE should be recorded at historical cost, which includes not only the purchase price but also any cost necessary to bring the asset to usable condition. For example, like for land is legal fees and title transfer and grading. For equipment is shipping, installation, testing. One topic that really stood out to me was the capitalization of borrowing costs. Is if a company construct an asset that take time to get ready, like a factory, the interest cost during construction can be capitalized and add to the asset value. This made me realize that accounting isn't just about recording what happens, it's about matching the cost of to the benefit. I also explore the treatment of self-construct assets, which involves estimating labor, materials, and even a share of overhead. It showed me how accounting blend both quantitative details and professional estimation. Finally, I learned how to record the disposal of PPE. When assets are sold or retired, the first thing is remove both the asset and accumulated depreciation. The second one is record any gain or loss based on the book value vs proceed. Okay, this taught me that even that the of an asset life affect the income statement and possibly tax or financing ratio. This chapter reveal how much long-term investment strategy is embodied in accounting treatment. Okay, chapter 12 is intangible asset. Chapter 12 was one of the most intellectually challenging and fascinating chapters. I had always known about tangible assets, but I hadn't fully appreciated how intangible assets can hold tremendous value even without physically from. Intangible assets include its patent, copyrights, trademark, software, license, customer list, and goodwill. I learned that intangible assets are recorded at cost if purchased, but when internally generated, only development costs, not research, may be capitalized under IFRS and only if a strict conditions are met or technical feasibility tend to be complete, ability to sell, and etc. This chapter helped me to understand the difference between finite life and indefinite life intangibles. Finite life asset, example like a 10-year software license are amortized over the useful life. And then for indefinite life asset is like a trademark with not forcible and are not amortized but tested for impairment annually. Goodwill, perhaps the most interesting intangible, it only arises from a business combination and reflects the excess purchase price paid over the fair value of net asset. I found this very insightful. Goodwill represents the value of reputation, brand loyalty, and synergy. Unlike other assets, goodwill is not amortized but tested to effort in impairment. If a company overpays and future benefits don't appear, an impairment loss must be recognized, which can heavily impact net income and shareholder confidence. This chapter shows me how the intangibles require more than the calculation. They require judgment, foresight, and ethical rewarding in industry like technology. Particular intangible asset may be the most valuable component of the company work. Okay, for okay. Okay, for chapter 13 is about current liabilities, provision, and contingencies. The final chapter taught me how to recognize and report obligations, especially those expected to be settled in the short term. Current liabilities include account payable, notes payable, accrued expenses, salaries payable, unearned revenue. The most meaningful part of this chapter was learning about provision liabilities that are uncertain in amount or timing. Under IFRS, a provision is recorded only when the first one is there is a present obligation from a past event. The second one is an outflow of economic resources in probable. The third one is the amount can be reliably estimate. For example, if a company expects to pay environmental funds or warranty repairs, it must estimate and record a provision. This requires judgment and transparency, especially in industry with legal or environmental risks. I also learned the difference between contingent liabilities and possible obligations that depend on future events pending lawsuits. The second one is contingent asset, potential gains that cannot be recorded under IFRS, only disclosed if likely. Mm, this conservative this conservative approach ensures that financial statements do not overstate a set of understated liabilities. Lastly, I studied the reclassification of short-term obligation as long-term. If refinancing agreements are in place before the reporting date, this can be significantly affect liquidity ratios like the current ratio and the quick ratio, which are key tools for investors and creditors. The final version chapter 8 and 3. After deeply studying chapter 8 through 13, I come to appreciate how interconnected accounting really is. Inventory affects income, asset affects equity, liability affects liquidity. Every single journal entry and policy choice tell a story about the company's strategy, financial health, and future outlook. For this chapter, help me understand that how business handle complex assets and liabilities, the role of estimation and judgment in financial reporting. What ethics, consistency, transparency are non-negotiable in accounting. As a student preparing for a future career in finance and or accounting, I now feel better equipped to read, interpret, and produce financial information that is useful, reliable, and fair. I gain not just academic knowledge but also the mindset of an accountant. One must think critically, ethically, and strategically. Okay, that's all for me. Thank you so much.